If this chart represented an investment you made, would you be satisfied with your investment?
No.
Of course not. Who would want their investment to decline at a rate of 3.22%? Now, does anybody know what this chart represents? Nope. This represents the value of the US dollar from 1913 to 2010.
Bad.
So, given that this is the value of the US dollar, how do you hold on to your money without your money losing value? Well, in order to solve this problem, first we're going to investigate deep into the reasons that this problem exists. Then we're going to talk about the causes as to why people think saving money is a good idea. And then we're going to talk about potential solutions so you can get a better grip of your financial education. I believe I'm a credible source to speak on this topic because I saved money my whole life from 0 to 18 years old. And around 18 years old, I became an investor, and I would never go back to purely saving money because I enjoy investing a lot, and it's helped me have some reasonable gains. I believe this is important for everybody here because if we learn how to invest at such a young age, we can actually retire early, or at least retire with a healthy amount of money that we are self-sustaining and not reliant on others or the government for our financial stabilities in the future. So the problem is that if your money is not growing, your money is losing value. According to Eileen Ambrose and Sandra Block from Kiplinger Personal Finance in an article titled Get Income from Life, last updated in October of 2017, the rate of inflation has been 2.2% since the year 2000, while the average savings account rate has been 0.06%. This means that if your money is sitting in a savings account, it is not keeping up with inflation and is actually losing value. So, this represents if you were to put your money in a savings account from the year 2002 to 2017 at 0.06% interest. You can check my math if you'd like, but your total value would end up being $1 million, $9,037.90. I'm sorry, I should have included you start with $1 million. Right. That's important. But the truth is that the value of $1 million in 2002 is $1 million, but in 2017, $1,009,000 is the equivalent of $741,000 in the year 2002, and this is as an effect of inflation. So, why do we think that saving our money is a good idea if our money is going to lose value if it sits in a bank account? If you ask me, this just flat out should not be encouraged. According to my survey, 77% of the people amongst yourselves have been encouraged to save more than to invest, or told strictly to save. Another 23% have been encouraged to save just as much as they've been encouraged to invest. However, that leaves 0% of the class that's been encouraged to invest, more they've been encouraged to save. This lack of encouragement to invest is why I feel that more than half of the people in this room feel that the stock market is either very risky or insanely risky. Another reason that saving has been pushed on us so much is because of the type of financial life us Americans tend to live. According to Carrie Close from Time.com, the average household has a credit card debt of $16,061. This article was last updated December 2016. So now, if you want to pay off high interest debt, yes, of course, the first thing you have to do is save money. However, our student loans are not that high interest, and I do believe we should pay them off. But the point is, I don't believe most of us in this room have $16,000 of credit card debt, and if we do, I promise you, you should be saving money, you should be paying down your credit card debt. But I'm going to speak on behalf of those who do not have $16,000 of credit card debt. So, saving your money is an okay strategy for anybody, obviously. It's better than spending it, of course. However, according to my survey, 91% of the people amongst yourselves believe that your education is an investment. So why would educated investors like yourselves follow the exact same advice as uneducated non-investors? Sorry. So, well, my answer to that is flat out, you shouldn't. This graph right here represents 3 different values. The lower blue line, the very bad one that nobody would want their investment to sit in, that is the US dollar. The red line represents bonds, a very safe investment. And the green line represents the stock market, which obviously has the highest investment. As you can see from this graph, yes, stocks move up and down more than the US dollar does. Yes, they are a little bit more unpredictable. However, I hate when people tell me that the stock market is more risky because you're basically saying it's less risky because you don't know where it's going to go, implying that the US dollar is less risky because you know it's going to go down and you can predict that. So, so if we reference my earlier example of saving $1 million in a bank account from 2002 to 2017, let's take that $1 million and let's stick it in one of the simplest investments you can make, which is the S&P 500. It represents the biggest 500 countries in America. You could very simply buy this with 5 minutes of Googling. So, the average return from 2002 to 2017 was 285.829% total return. So if you dropped $1 million in there, 15 years later, you would have more than tripled your total value to $3.8 million, which when adjusted for inflation is the equivalent to $2.8 million, being much better than losing your value down to $700,000. So, my solution to you all is to pay off your high interest debt first off, if that is your situation. But once your debt is paid off, I would like you to change your mindset from a saver to an investor and focus on growing your wealth. So don't focus on saving money so much. Focus on buying assets such as the S&P 500. But you don't have to take it from me. Take it from the third richest man in the world, Warren Buffett.
Once you're looking for companies, and you have to find them yourself. The world isn't going to tell you about great deals. You have to find them yourself, and that takes a fair amount of time. So if you're not going to do that, if you're just going to be a passive investor, then I just advise an index fund bought consistently over a long period of time. The one thing I will tell you is that the worst investment you can have is cash. Everybody's talking about cash being king and all that sort of thing, but most of you don't look like you're overburdened with cash anyway. So, but cash is going to become worth less over time, but good businesses are going to become worth more over time, and you don't want to pay too much for them, so you have to have some discipline about what you pay. But the thing to do is find a good business and stick with it.
Oops, sorry. As you can see from Warren Buffett has the exact same opinion as I do, which is to invest in an index fund if you don't have a lot of time. I also recommend you dedicate 3 hours of your life reading the 92-page book called Rich Dad, Poor Dad to change your financial education. So take your time now to learn and enjoy your retirement when you're 50 years old. Now that we've gone over the problems, causes, and solutions to saving money, you can now see why investing in the US dollar is a bad investment. It's also important to start early. I just wanted to demonstrate how if you start at 22 years old and you save $500 a month, you'll have $1.8 million. If you start at 30, you'll have $1 million. So those 8 years can cost you $800 grand in the long run. Thank you.